You're listening to the Wealth Mindset Show, where Hicks and Zerker Capital Management's team of finance professionals, portfolio managers, and a life coach come together to tackle complex topics in finance and retirement planning so you don't have to. From investment strategies and wealth management to tax planning, retirement income, and aligning your money with your values and purpose, the Wealth Mindset Show offers the tools to thrive.
All right. Hey. Welcome back to the Wealth Mindset Show, where the Hicks and Zerker team helps you manage wealth, navigate retirement, and make smart decisions for a secure, meaningful future. I'm Austin Wilson, Chief Investment Officer at Hicks and Zerker Capital Management.
I'm Josh Robb, Director of Wealth Management at Hicks and Zerker Capital Management. And Jessica Hinks is joining us today, one of our senior wealth advisors. And we are going to be talking about her favorite subject, which is passive management of investments.
Or versus active.
Versus active.
Yeah. And I want everyone to take note. He is being sarcastic. I literally asked, was no one else available? I specifically remember when being interviewed for this job years ago, Adam Zerker asked me, so what's your investment philosophy, Jessica? And I was just thinking, I don't have one. But I have developed pretty sincere philosophies since then, although it's not necessarily my most active part of financial planning.
No, it is.
Gotcha. Yeah.
We are more passive
if
because
it was about
we have
being
somebody
passive aggressive, I would be a knockout for this topic.
That's
right. Well, this is cool. But first of all, what's going on with our lives? First of all,
snowstorm.
It's a snowstorm time, and it's very cold.
Yes.
At the time of this recording.
Yeah. I've always said, I grew up here in Ohio for most of my life, that having 4 seasons, I do appreciate the difference of them all.
To a point.
And while we're in winter, if it's going to be cold, I want snow so that the kids can actually do something.
But
right?
now it's so cold they can't.
Yeah, now we went to the extreme end where the wind chill is like -10. It's like you could be outside for 5 minutes and then you better get back in. But when we got this snow, we got 10 inches of snow or whatever. We were able to go out for little periods of time, do some sledding, build the snowmans, which is so cold. You can't really build a good snowman when it's this
snow
cold.
Is dust.
But they were able to go out and do all that, which is, again, makes it easier to tolerate this season, I think, when you can go out and do those.
Well, the snow's sticking around for a while. So.
It's not going anywhere, that's for sure.
Jess, what about you? You got unburied?
Yeah, I got unburied.
That's good.
I'm a worrywart, so I literally spend my days worrying about frozen pipes and breaking furnaces. Yeah. And wouldn't you know, my furnace got really angry sounding this week.
Did it get fixed?
It got fixed literally like a couple hours ago, an hour ago.
All good.
So shout out Harold Chuck Company.
Nice. Yeah, my 3-year-old now. She's 3 now as of January 11th.
Yes.
But she decided she wanted to help me shovel snow because obviously there's a lot of snow to shovel. She followed me as I'm either blowing snow or shoveling. She would follow behind me with her little sand shovel. That's the only shovel we have, which I need to buy her a better shovel.
You need to get, yes.
And she would put it back on the concrete behind me as I was shoveling. And I was like, honey, that's really not helping. That's why I'm putting it back. So, yes, we're in a bit of a blizzard here. It's 0 degrees and we have a foot of snow laying around. But it's all good. We're warm in here.
We're warm.
It's sweater weather.
Yes.
Which I'm cool with. But today, we're talking about markets and investment styles and really just trying to get our minds around what the markets look like now, because they look different than they have for a very long time. Yes. There's some key things we're going to be talking about there, and also just some investment philosophies. Obviously, we have our own we're going to talk about. Other people have theirs, and it works out for them. But we're going to talk about why and how that is today. So first of all, markets ended 2025 really strong. We had a third 15+% year in a row for the S&P 500. Really great stretch as of the end of the year, and that's actually continued. Markets are up a little bit year to date thus far in 2026. However, there's a lot of choppiness going on. We've got more discussion on tariffs and trade. We've got geopolitical stuff with Venezuela. We've got Fed chair nominee as of the day of this recording. We have a potential new Fed chair coming later this year. Valuations, we've talked about many times, stretched.
Potential government shutdown.
Another potential government shutdown. Feel like we just had that. Yep. So the question is, when we're looking at our portfolios, we need to know what's in them. What is in these portfolios? Are we protected for every scenario? Because, you could say, hey, look at my retirement plan. You're going to log into your 401k and say, I've got 7 funds in here and I'm good to go. I'm well diversified. But are we? And the answer is probably not.
Or not as much as you think.
Not as much as you think. That's exactly the way to think about it here. So let's talk about, again, this is not active is good, passive is bad, or vice versa. Yeah. Passive is good and active is bad. Some people take that approach because we're admitting some people, and a lot of people, have some form of passive investment in their portfolio, in their retirement plans, and it can work out very well for you as long as you stick to your plan. It's more about the planning that matters as long as you're well diversified.
And whatever strategy you come to, do your best to stick with it, because that's really what we see as advisors a lot, is jumping from one thing to another, just trying to always go after this new strategy or solution. And just find something that makes sense for you, you understand, and stick with it, because that consistency is really where you're going to get the most value. And you're right, there's no right answer. It's, I don't know, like ice cream flavors, right? There's all out there. Find one you really like and then stick with it.
There is a wrong ice cream flavor.
Is it what, vanilla?
Anything with mint.
Oh, yeah, I know you don't like mint. Yes.
That's a toothpaste, not ice cream. I don't eat mint.
I don't know. A couple of my kids like mint chocolate chips.
I know, that's my father-in-law's favorite
ice
ice cream. I know. So, but this is saying there are ways for that to work.
Yes.
At Hicks & Zerker, however, we are active, right? So we use active mutual funds and ETFs. We actively manage equity strategies. We feel that gives us the most control over what we do when we build client portfolios. Again, that's not saying that's the only way to do it, but that is, if you hear a little bit of bias, there might be a little bit, but we're admitting up front there are more than one way to skin a cat. And that's a terrible metaphor, but that's what people say, right?
Yes.
There's more than one way to skin a cat.
I don't know why you need more than one way or why you do that to begin with.
So let's talk about how much, where, and what kind of risk you're taking as it relates to your overall portfolio. So again, you're looking like you're diversified. You look at your portfolio on paper, you've got 7 funds. Great. What we need to understand is that U.S. passive equity exposure at all-time highs. And that's not necessarily the worst thing in the world. Nearly half of U.S. equity exposure is passive, right? But we need to understand what is in a passive equity portfolio, specifically as it relates to the U.S., because things look different abroad. But as it relates to the U.S., the Mag 7 we've talked about a million times. These are 7 of the largest United States companies, and almost all of them are technology companies or technology adjacent companies right now. They make up an enormous portion of the overall index. Here are just some of the top ones, right? NVIDIA, largest company in the world. Over $4 trillion in market cap. It is nearly 8% of the S&P 500. Apple's over 6%, Microsoft's 5%, Amazon's 4%, Google's another 6% if you combine their 2 share classes. Meta and Broadcom are each 3% of the S&P 500. So just in a real quick, little sliver of 7 or 8 companies there, you're talking about 30-40% of the index.
35%.
Right? Just within 7 companies. Now, what that means
over a third
is
there.
7 companies. What that means is that the index, even very much compared to historical averages, is concentrated well above average levels, right?
And that goes back to, and I know we briefly hit, but passive investing really just means your investment is tracking a set group of holdings, usually an index. And an index is, again, just a
most indices are market cap weighted. That's where this is coming.
Yes. And we'll talk about a little bit more of that, why that, from a passive standpoint, that may matter. But again, nothing wrong with passive, because you know what you're getting on a consistent basis. You're getting what the broad market has directed, which, again, like in this case, we're talking about S&P 500.
Nothing wrong with passive if you're okay with those 7 companies taking up a third of your portfolio.
Well, and I'll be the first to admit, we own a handful of these, a lot of these companies, if not all of them, in some way, shape, or form. These are great companies. These are probably, and I'm going to say this with some confidence, some of the best companies to ever exist. And they do it by generating great earnings, great growing earnings, great growth. They're in products that we use every single day, or they're key components of products we use every single day. So that being said, there's a reason they're so large. And the reason they're so large is they are in demand, right? They're in demand and they're being used all the time. But I think even if we take a step back and we look globally, because we were just talking S&P 500 ratings, these companies have gotten so large that they even move the needle on a global scale. So the U.S. represents 60% of the global equity market in terms of total market capitalization. So therefore, these large companies in the U.S. are still a large chunk of the global equity market. So NVIDIA, for example, while it's 8% of the S&P 500, it's over 4% of the total world stock market.
I think, did we say that NVIDIA was larger than Canada and Japan
Yes.
Their entire...
It is
crazy how big this one
larger than
is.
markets. Larger than entire markets.
Yeah. Not the building size.
Yeah.
I was aware of that.
Yes,
Thank you.
Not the people.
Not the people. But yes, one company.
Their market cap, which represents their assets or their income, their profit based on the number of shares they have, right? That is bigger than the whole Canadian stock market, is what you were saying, or Japan. And so that's just crazy to think that one U.S. company has more market share, more market cap than a whole country's market.
Oh, absolutely.
Just crazy.
So like I said, NVIDIA, over 4% of the global equity market. Apple, nearly 4%. Microsoft, over 3%. Amazon, over 2%. Google, nearly 4%. These are large companies on a global scale. This is interesting, the first top 8 holdings of the global equity market are United States stocks. And they're all growth stocks.
Yep.
These are all technology or technology adjacent stocks here in the United States. The first non-US tech name, or non-US name in general, but non-US, not a US tech company, or non-US name period, is Taiwan Semiconductors, which does what?
Makes semiconductors.
Makes semiconductors for these guys.
Yep.
Like specifically NVIDIA. So it's and that's only 1%. So it's amazing that the top 8 companies in the world are U.S. companies, and specifically U.S. tech companies. You don't have anyone else outside the U.S. until number 9. And then even so, there's only a couple in the top 20 that are U.S. companies.
God bless America.
It is, the American market has historically done exceptionally well. And as of the last 20 years, crushed the rest of the world in terms of performance. And that's the reason a lot of these companies have gotten so large. It was not until 2025 that we actually had a meaningful reversion where international stocks did significantly better than U.S. stocks. And that's what we saw last year happen here. So that brings us to some good discussions here, right? So when you're looking at your portfolio, again, what you're getting is this weighting if you're invested passively. And you're getting what the market gives you. The market says these companies are worth 4%, over 4% of the global equity market, or 8% of the S&P 500. The market's saying that, right?
Yep.
So you need to know and be okay with, I'm buying the S&P 500 index fund for my retirement plan. I know 8% of that's going to be in NVIDIA, and I like it. And that's just okay with it. I'm okay with the risk. The question is, but down to the risk, what happens if some of these large companies, like these are multiples in size of the companies smaller than them. What happens if one or two of these large companies stumbles? And what's the most recent example that's coming to mind? Microsoft. Yesterday, on the same day that Meta was up 11%, Microsoft was down 10%. Microsoft's the third largest company in the world, and it significantly moved the index. And it's because it's 6% of the S&P 500. If one company is down 10% in one day, and it's 6% of the index, that's trimming off a whole bunch of market cap. So that's why this index concentration is something that people like us are watching. People like me in my role, we're noting the risk. Just because of concentration, if one or two of these large companies, or if it's because all these companies are essentially AI tech adjacent, if this theme starts slowing down and has a major sell-off, think DeepSeek, right? That was the thing that happened in early 2025, then the overall index is going to be down significantly, where an active manager would be able to then underweight some of these names and take off some of the risk. So that's where this comes into some discussion.
And then if you take that and then extrapolate, going back to your original example of you log in your 401k and look, hey, I got 7 holdings in here. I chose them because they all look good on their performance. You may have 2 different funds doing the same thing. And that's where you get to kind of, in a sense, stacking these funds that you think, oh, that helped diversify me. Now I have 2 different funds doing different things. Well, if you look at their underlying holdings, you're going to see that where, in a sense, you just double down on the same investments, doing 2 different funds doing the same thing.
That works great when it's
great,
doing well.
That can be deceiving, and that's, I always think, going back to like my kids, my youngest son, he's in a fantasy football league, and I think your husband does some fantasy football stuff.
Very successfully, yes.
And my son also loves certain football teams. So during drafting, he tends to stack a bunch of the same team's players on his fantasy team. And we've had this conversation of, hey, if they have a bad game, you're going to have a lot of players that are going to have that impact. And that's really what this is, hey, I have these 2 funds. That's great. Well, if they all own the same thing, they're going to do the same thing. They're going to move the same direction. You're not diversifying. In fact, you're just amplifying those holdings even more.
It's kind of like if If you're using the same engine in 7 different cars and the engine breaks, all your cars are broken.
Yep.
Right? Because it's the thing driving all of them,
right,
is these large companies.
Yep. Have you ever felt overwhelmed by the complexities of managing your wealth? You're not alone. At Hicks & Zerker Capital Management, we specialize in helping affluent families and individuals navigate the complex challenges of managing their finances. Wealth management is all about combining thoughtful financial planning with active investment management to help you reach your goals. Our process is designed to guide you toward what truly matters because we believe wealth isn't the destination. It's a vehicle for something much more meaningful in your life. Achieving your dreams requires careful planning, smart decision-making, and access to high-quality investments. That's where we come in. We understand that complex financial situations call for deep expertise in investing, tax strategies, and retirement planning. But our approach goes beyond that. We integrate your financial goals with your core values, helping you visualize the possibilities your wealth can create for a secure future. If you're ready to take the next step, visit hzcapital.com/start to see if we'd fit into your needs and to schedule a call with us. Again, that's hzcapital.com/start. Now let's get back to today's episode.
Is this a bad time to ask how you feel about equal weighted?
That's actually a great question. And that's something that's become very popular, right? So one of the themes of 2026 is the broadening out, right? Not saying these things are going to do bad, these large companies, but other companies might do a little catching up is kind of the thinking. So yeah, there are ways to use an index and say buy an equal weighted S&P 500 index, where instead of NVIDIA being 8% like it is and Microsoft being 6 or whatever, you hold all 500 companies equally.
The same.
Yeah.
Doesn't matter how big they are.
They're all getting this. So that means that these large companies are not deriving all the returns. And actually, year to date in 2026, on an equal weighted basis, that has outperformed the market cap weighted index.
And Microsoft going down,
it's
going to have less of an impact on an equal weighted than it does on a market cap weighted.
Absolutely.
On the other end, when you have a really positive outperformance by individual companies, you're going to have less upside. So those are the trade-offs you always get.
For the record, to those who aren't watching us on YouTube but are watching us on podcast, Austin is absolutely glowing right now. This is a topic he loves. This must be how he
gets so excited.
Normally, Josh and I get to talk about financial planning, and you kind of get to sit there a little more quietly, but this is your jam. Happy for you to have this moment.
I know. I wonder if this was my idea. But it was. So yeah, let's talk a little bit more. Again, this is where it's all about risk. And one thing that I think that is a very common thought in investors' retirement planning today is I'm just going to put all my eggs and all my retirement funds in the S&P 500 and never touch it, and it's going to be just fine. And you know what? That's actually worked pretty well for a long time.
Mm-hmm.
However, a prudent investment management philosophy will not say that is enough, right?
Mm-hmm.
It's not enough diversification. It's done well historically.
Things were different.
Things were
different. I never thought I'd say that. I hate that phrase.
Unprecedented. But no, we've been in such a season of large cap tech companies doing well, which are what's the biggest component of the S&P 500, and B, international stocks really sucking, right? For 20 years. Mm-hmm. And we're starting to see the tide shift a little bit. So this is where we would say, hey, if you want to have an S&P 500 index fund, or I would say maybe a large cap core active manager, yeah, great. You're going to get a great U.S. large cap return. You need to be pairing that with some developed and emerging market stocks, both outside the U.S. The world equity market has about a quarter of it in developed market stocks. The world equity market has about 10% or so, or a little bit higher in emerging market stocks. You probably should have some exposure to these large components, which they have a lot going for them, right? As of 2025, international was outperforming, of course, so that's good as you're buying some momentum, but valuations continue to be significantly cheaper than they are here in the United States, and dividends outside the U.S. are significantly higher. So a couple good things going for you there. We're seeing some structural shifts in terms of policy. A lot of these countries like Japan, South Korea becoming very shareholder friendly in terms of giving their large companies, tasks to go deploy capital and give it back to the shareholders, and dividends and buybacks and all kinds of stuff, becoming a lot more like the U.S., frankly. So that's really good there. But again, it's 40% of the global equity market outside the U.S. You need to have some exposure to that. Most Americans' retirement plans greatly underexposed.
Yeah.
Do you guys see that in terms of people you talk to?
Well, yeah, because a lot of times, and again, just talking to the average investor here, when they look at choosing their 401k allocation, one of the things they look at is returns. And if, like you said, the last 20 years, you've seen this outperformance of U.S., when they're looking at trailing returns, they're going to choose the funds that have done real well. Well, what are they going to weight in? They're going to be heavier in the U.S. Because when they're comparing, this one has averaged 10%, this one's only averaged 6%, I want the 10% one.
Absolutely.
Well, that's probably because they're two different areas of the market, and 6 may be great for what historically you needed from it. But when you're just looking at total return from those buckets, you kind of end up heavier weighted into the U.S.
And that is why if you're a do-it-yourself investor in your 401k or retirement plan, but you maybe lack some expertise, I almost would always just recommend a simple age-based fund. Because even though you might be more heavily skewed to the tech companies, those Mag 7, than we might like, at least they are incorporating some global diversification
and rebalancing.
In those.
It's automatically rebalancing.
That's
so if you're going to go
hybrid.
passive, that's my preference rather than just trying to guess your own.
Passive, because while it's holding passive investments, an age-based strategy is actually going to adjust for you as you get closer to that endpoint.
It's not static.
So, it's not necessarily actively managed, but it's going to be actively adjusted on a set schedule so that your allocation changes. And I think that's, like you said, if you're going to be doing something with very little oversight or continuing observation, that's one of the best ways to go because of the structure of it.
Another thing is if you're looking at long-term retirement planning, of course, wherever you are, it depends on your time horizon that you need you're going to need money for, right? So it could be long-term, then we would say, that's probably going to lean more towards equities. But the shorter you get, you may want to start thinking about introducing fixed income into the situation for diversification purposes, for stability purposes. And now, frankly, it's a decent time to be thinking about fixed income. Yields are still higher than they were years ago, higher than we were coming out of the global financial crisis for a long time, really since out of COVID. And the risk reward in fixed income is actually pretty favorable right now. So if you look at elevated yields, historically speaking, and where are things going right now? Well, the Fed's cutting rates on the short end. The long end's probably going to remain pretty elevated. You can lock in decent returns. Essentially, if you look at like the 10-year Treasury yield, which is right now about 4.25%, that's probably going to be your 5-year annualized return roughly for a core bond portfolio. 4.25% is not bad. That's not bad without taking a lot of risk. Lower volatility, lower risk. So they are a tool, and not just a ballast for your portfolio, but they can be a tool to, if equities get weak all of a sudden, they've been strong, really strong recently, this could obviously help your overall portfolio. And again, as you get closer to retirement and into retirement, they could definitely have their place to really balance you out there.
Yeah, they give you that reduction of market movement in a portion of your portfolio compared to just an all equity. It is an adjustment. You will not get the returns.
No.
Because there's always a trade-off. If you're going to take less risk, you should expect less return.
Absolutely.
And if we're wrapped up with fixed income, I wanted to throw in a little bit of a topic that I don't think was on the agenda, and it's my only contribution to this conversation. And it's why I like active investments for psychological reasons. Because I don't watch investments all day like you do. I'm not the director of investments, but I am sitting in front of human beings all day, being a financial advisor with clients. And I see how people respond during market volatility. And when things are going wrong, we as humans just feel like we need to act, like we need to do something. It doesn't have to be the right action or a huge action, but something that proves to ourselves that we are looking at the world around us and we're doing something to improve our lives and our surroundings. And so sometimes even if you're just explain to a client, you know what, we're going to make, we are looking at 1 to 2 company purchases here, companies that respond better in this economic environment. Even if it's just a few % change in a portfolio, it can be enough to really bring peace of mind. You're still sticking to the long-term plan, but I think you're just kind of adapting to human nature, which is important.
Absolutely.
Right. And it always reminds me, they did a study, you and I both played soccer. Goalies in any kind of penalty kick, statistically, standing still gives you the highest chance of stopping a ball. But yet every goalie is going to choose a direction and dive because doing nothing just doesn't feel
right.
And I think you're right in that. In investing, doing something makes you feel better. and doing something within the confines of sticking to your long-term goals, there's nothing wrong with making adjustments. That's totally fine.
Right.
Abandoning your strategy is what we always talk to avoid, making that big mistake. But yeah, definitely say, hey, if I tweak this here or there, and that's where that active comes in, I just feel better. And it helps me.
And you probably will have better outcomes as well.
If you do it right. Yes.
Yeah. Well, another two components of that, where we're specifically talking about active equities, right? So we're managing stock portfolios. Another thing that I think helps clients is they can go to their Fidelity app and they see you're holding 35 different companies, and they're looking through that list in volatile times, and they're like, Costco's down 20%, but Costco's not going out of business. Not a recommendation, by the way. Or Apple. Yeah, I'm still using my iPhone, even though it's down a lot.
Yep.
I think that brings a lot of peace of mind.
When you break from a name of a mutual fund that holds 100 holdings,
it looks
to
like
the
gibberish.
individual company to say, this company, which I'm owning, is it going to zero? And zero means they're out of business, or are they going to be okay in the long run?
Absolutely.
And that's what you're talking about.
And the other component to active equity investing specifically, and you can also get this with direct indexing or whatever, but tax loss harvesting opportunities, individual securities, $1 saved on taxes is the equivalent in someone's mind of making them 10, right? That's the investment philosophy. I read that in a book. It's a real thing, right?
Sure.
Tax savings carries more weight than
it feels
money
good.
other
Yeah,
things.
exactly.
It feels good to
so
take money back from what you would have paid.
Therefore, if you're looking at the opportunity to save on some taxes, great. That's a great opportunity because you can obviously harvest some losses on some individual names, because that's going to, in an index fund, it's going to be buried. You're not going to know. You're going to get the total return, but you're not going to be able to do that. So another opportunity, I think, where that has some opportunity. So yeah, passive can work. We just are advocating, know the concentration, know the risk, understand the markets. I mean, if you watch business news, they talk about how large these companies are all the time and how big a portion of the S&P 500, for example, they are. It's just good to get your mind around there, and then making sure that even though you think you're diversified by holding 5 funds, making sure they're not all holding the same thing is really key.
Yes.
And then continuing to advocate for international emerging market exposure, maybe fixed income if it fits your financial situation. Just making sure you're well diversified. Don't put all your eggs in one basket. Like I said, passive can be fine, but you just have to be aware of what's going on underneath. So any other final thoughts from you guys?
Yeah. Again, whichever direction you choose, we've talked about it a lot. Stick to a plan, come up with a good strategy that gives you high probability of success to meet your goals.
Yeah.
And then just stick with it. Even if there's little tweaks along the way, that's great, but stick to the plan.
Right. Cool.
No further comment.
All right. Well, if you found value in this conversation, don't forget to subscribe to the Wealth Mindset Show on whatever platform you're listening on. And feel free to visit us at thewealthmindsetshow.com for more resources or our show notes or whatever you want to know. And if you want to know more about what we do at Hickson Zuercher Capital Management, visit hzcapital.com. Otherwise, we'll see you next episode.
All right. Talk to you later.
Bye.
Thank you for joining us at the Wealth Mindset Show, where we tackle the complexities of finance and life planning to help you align your wealth with your values. We hope today's conversation provided value and clarity as you navigate your financial journey. Your hosts work for Hickson Zuercher Capital Management, and all opinions expressed by them or any podcast guest are solely their own and do not reflect the opinions of Hickson Zuercher Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hickson Zuercher Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment, and any investor attempting to mimic index performance would incur fees and expenses that could reduce returns. Securities investing involves risks, including the potential loss of principal, and there is no assurance that any investment plan or strategy will be successful.